I'm Lisa Wilson, and I will be presenting Tax Strategies for Education Funding. Why tax strategies for education funding is important. Because education planning and funding is one of the top goals for many families. Tax strategies help alleviate the cost of college education, and tax deductions, credit loan forgiveness, IRA distributions, and UGMA and UTMAs are methods to implement a tax strategy. What are the tax deductions available? Congress permits taxpayers to deduct education-related expenses. Deductions reduce taxable income, and taxpayers do not have to itemize deductions. Student loan interest deductions is before the adjusted gross income, or the AIG. Taxpayers are allowed to deduct up to $2,500 of interest expenses per year. The phase-out threshold for a single taxpayer is $70,000 to $80,000, and married filing jointly is $140,000 to $170,000. There are additional deductions part of the student loan interest, and these deductions are loan origination fees, financial institution charges associated with issuing a loan. Credit card interest expenses, only applicable if the credit card charges were used solely for the qualified education expenses. And capitalized interest expenses that is added to the outstanding balance of a loan while the student is enrolled at least half time. Loan forgiveness programs. Loan forgiveness is considered income for state and federal tax purposes. There are specific exceptions under the Internal Revenue Code Section 108. Loan forgiveness is excluded from income if the forgiveness is contingent upon the student working for a specific number of years in a certain profession. Now, non-taxable loan forgiveness programs are public service loan forgiveness, teacher loan forgiveness, law school loan repayment assistant programs, and National Health Service Corps loan repayment programs. Now, there are taxable loan forgiveness programs, and these are loan discharges for closed schools, false certifications, unpaid refunds, death and disability. What is the difference between the American Opportunity Tax Credit and the Lifetime Learning Credit? The AOTC is a $2,500 tax credit per student per year for the first 4 years. Taxpayers receive up to 40% as a refundable credit. The phase-out threshold for a single taxpayer is $80,000 to $90,000. Married filing jointly is $160,000 to $180,000. Qualified education expenses do not have to be purchased directly from the university. Now, the Lifetime Learning Credit is a $2,000 tax credit per family for an unlimited number of years. Qualified education expenses must be related to a post-secondary degree program or to improve job skills. The phase-out threshold for a single taxpayer is $58,000 and $68,000. Married filing jointly is $116,000 to $136,000 and requires related education expenses to be paid directly to the university. Now, these are major differences between the AOTC and the Lifetime Learning Credit. What are qualified and non-qualified education expenses? Qualified education expenses are tuition and fees, student activity fees, books, supplies, and equipment. Non-qualified education expenses are room and board, insurance, student health fees, and transportation expenses. Are scholarships included in taxable income? Yes, they are. A scholarship may be taxable if the scholarship is used for expenses that do not qualify, payments for services, and scholarship prizes. Tax implications of using IRA distributions. Taxpayers need to be concerned with if the IRA is subject to an income tax and if the distribution is subject to penalties. The IRA distribution can be used for college funding, but will be treated as a taxable income. There is an early withdrawal penalty if the distribution is made before 59.5 years old, and the distribution is not used for qualified college education. Advantages and disadvantages of UGMAs and UTMAs. The advantages of UGMAs and UTMAs are these accounts allow minors to own cash, securities, and real estate. The custodian of the account manages the account for the benefit of the minor. Now, disadvantages of UGMAs and UTMAs are when the minor reaches the age of majority, which is 18 to 21 depending on the state, the minor can use the assets as he or she sees fit, and not necessarily for the intended college education. Now, there is a kiddie tax issue, which is unearned income that is above the threshold of $2,200, and the additional unearned income is taxed at the rate for a trust and estates, which is likely to be higher than the child's rate. So in conclusion, student loan tax deduction, loan forgiveness programs, tax credits, scholarships, IRA distributions, UGMAs, and UTMAs are methods to develop a tax strategy for education funding. Each has advantages and disadvantages, but implemented correctly is a useful tool to lower the cost of a higher education.